Yeah, it started. Buyers have been completely squeezed by the 3% buffer banks are adding, and it could get worse next year with some of the predictions. Let me tell you about it. So, Jonathan got in touch with me in March this year. He'd tried investing in crypto, did his dough, tried shares, didn't go so well, and thought property was an easy hedge. So, we did a pre-approval for him in March this year for 500,000 to buy a home around Logan on the west of Brisbane. Lucky for him, he'd sold enough shares, so he had about $100,000 to put towards his deposit. And with his work in landscaping, he was pretty handy on the tools. So, he was keen to find a place that needed a little bit of work, maybe a bit of liquor paint, a kitchen, spruce up. Anyway, we got a pre-approval in March for a $400,000 loan, and life was good. But you know how it goes. Things got in the way, the year moved on, and unfortunately his pre-approval expired. Until he finally found the perfect place last week. It was in Crestmead, just west of Brisbane, and they're asking for offers over 495,000, just like his pre-approval we'd done earlier in the year. So we started talking on the phone. I opened up the bank calculator, thought I better just check see if any of the figures had changed. Jonathan was still in his same job doing landscaping, deposited pretty much stayed the same at 100,000, except things hadn't stayed the same. The RBA had increased rates 6 times this year. And although it had only been 6 months since we'd done Jonathan's pre-approval, his borrowing power had been slashed. And that's very same bank that pre-approved him for a $400,000 loan 6 months earlier is now only willing to give him 330,000. His dream of buying a home has gone. And his home purchase of 500,000 became one for 440,000. So today, let's run through why buyers are losing their home deposits because of rising rates. We're going to go through why higher rates and tougher conditions may mean prospective buyers won't qualify for a loan, even if you got pre-approved last week. And we're going to work through how to maximize your borrowing capacity so you don't fall victim like Jonathan was.
If you find these videos useful, do me a little favor and hit that subscribe button to keep up to date with all things property and finance.
Nathan, so let's run through why higher interest rates have had such a massive impact to home buyers like Jonathan.
Yeah, we see this a lot, and unfortunately, Jonathan isn't alone, and it is something for a lot of buyers out there to bear across. We've seen interest rates rise in the last 6 months. The Reserve Bank's had 6 rate rises in as many months, and as a result, the bank's assessment rates that they're using to assess borrowers and their ability to repay a loan has increased. So we've seen that increase quite substantially as the banks have an interest rate buffer they look at when assessing an application. That's usually 3%. So they add 3% on the actual rate that you're getting and assess, can Jonathan pay a mortgage if rates were to get to 7%. And that's what we see in Jonathan's story here. Borrowing power has reduced as rates have risen. And unfortunately, for a lot of borrowers out there, they've lost at least 20 to 25%, in some cases 30% in borrowing ability due to these changes.
So in Jonathan's case, earlier in the year, the assessment rate was around 5%. And that's why his borrowing capacity was substantially higher. Like I said, it was over $400,000 at that point. Fast forward to today, they're using an assessment rate of 8 to 8.5% because they're adding on extra on top of their current rates, and things aren't looking as rosy. So the first tip you want to take away is check what your bank's policy is around their pre-approval. You want to go with a pre-approval that they actually lock in and will honor the assessment rate when they pre-approve you today to make sure you can reliably go and make offers on properties tomorrow and not find out, well, actually interest rates have gone up by 0.25%, by 0.5%, and your borrowing power has come back.
Yeah, it's important to be aware that not all banks are the same here. As Jaden said, some lenders, when you're pre-approved, they lock that in, you're good for 3 months, and they're not going to change that assessment rate on you. But other lenders will say you're pre-approved, but when you actually buy, try and reassess you on the new assessment rates. So I think it's key to make sure you're working with the right lender here so you're not going to have issues with your borrowing capacity.
Which leads to the question, Nathan, if I'm going to auction, if I'm pre-approved, the bank said, yep, you're good for $400,000, go ham. What's to say that if the rates change in the next 2 weeks, I'm not going to get caught out and potentially lose my deposit?
100%. I think this is something you need to be very careful with here. Going to auction, as we all know, you are unconditionally locked into the contract. You're putting 10% down. So if you don't get your finances through, you're in a really difficult situation where you're going to lose your deposit and potentially get litigated. This is where you need to work with a broker. A great broker will be able to go back to the bank prior to auction and just make sure your pre-approval still stands, your numbers are still locked in. It doesn't hurt to double check here. This is one thing that you want to be so cautious of. We've seen so much movement in rates in recent times. Even if you got pre-approved 2 weeks ago, 1 month ago, 2 months ago, I would be going back and triple checking that the numbers haven't changed. The bank's pre-approval still stands, and I'd be checking as close to the auction as possible. As an example, if the rate movement, so the Reserve Bank meets up again in November, you've got an auction in the second week of November, and the rates have gone up again, you want to be going back to the bank really as close to the auction as possible, because assessment rates will change again as interest rates increase.
If the property is on the market outside of auction conditions, you can look to make an offer subject to finance. This is going to be the best way to protect yourself and your interests from losing your deposit. So if you've found the right home, even if you're pre-approved, you can look at making an offer that's subject to finance. You can say, I'm going to make my offer subject to 7 or 14 days of finance. This will give us, as your mortgage broker, a new time to go and get your loan formally approved, unconditionally approved, where the bank says, yep, Jaden, here is your $400,000. This is your money. We will not change it. We're not going to change any conditions. Or alternatively, they could come back and say, hey, actually, you know what? We gave you a pre-approval for $400,000. It's $330 now. You actually can't afford this home. And the finance clause gives you an out. It gives you a way to rip up that contract and mean you're not going to lose your deposit. With all these interest rate rises, with the reduction of borrowing capacity, Nathan, how can you maximize your capacity? How can you maximize the amount of loan you can get? You might be even looking at buying investment property and trying to gear that up. You might be looking at different things. What are some tips you can do today to increase your borrowing capacity?
If you're like Jonathan and you found your borrowing powers reduced, there are things you can do. So one is shop around between the lenders. So each lender has a different assessment rate. They also have different numbers that they'll give you. So one lender might be giving you $330,000. Another might actually be able to stretch you to the $380,000. So be aware, not all lenders are the same. And that's where working with a great mortgage broker will help, as you can get yourself in a position where you can compare and contrast.
Interestingly, Nathan, even with each lender, they'll give you different amounts depending on the type of product. So sometimes if you're doing a fixed rate, for example, your borrowing capacity will be lower than a variable rate because the banks give you a lower discount on a fixed rate interest rate. They might give you 0.2% off their advertised rate, whereas with a variable rate, they might give you 2%. And that reduces the interest rate they're assessing you on and gives you high borrowing capacity. It even changes between products. If it's like a basic or a package, they can give you more capacity, and by the amount of deposit you have. So if you have a lower deposit, they'll give you a lower discount, potentially lower borrowing capacity. But if you've got a higher deposit, you've got 20%, you're seeing it's a bit lower risk to the bank. So they'll potentially stretch that borrowing capacity a little more. Again, like Nathan said, not all banks will openly advertise this. So a mortgage broker can help you navigate this and can work out what's going to work best in your situation. What combination? Do you do principal interest? Do you do interest only? These things can all make a massive impact to your capacity.
And the other thing you can do, which is a quick and easy win, is look at your liabilities as well as your HECS or help debt. For example, if you have a credit card, let's say it's $10,000 limit, for every $1,000 in limit you have, you're reducing your borrowing power by about $7,000. So a 10 grand limit will actually reduce your capacity to borrow by about 70 grand. So closing off a credit card will have instant effects. The same thing goes with HECS. Depending on your income, the banks assess your HECS repayment based on a percentage of your income. So if you're on a higher income, it means there's going to be a higher HECS liability, which therefore reduces borrowing power. If you've only got 5, 10 grand left on your HECS, in a lot of cases, closing your HECS can mean that you can get 100 grand increase on your capacity. Makes a huge difference.
I got a call from Sheena earlier in the week who had spoken with her bank and was trying to get an approval, had signed actually a property at auction, had bought it for about 600,000. And she spoke to her bank and said, the bank is only going to give me 400,000. What can I do? We went through her situation. She had a HECS, she had a credit card, she had a personal loan and a huge deposit. What we're able to look at is by closing her HECS, which was $30,000 owing, we were able to increase her borrowing capacity by $100,000. It was wild because with HECS, the way the bank calculates repayment is not by the amount owing, it's by the amount that you pay proportionate to your income. So if you're on $100,000, they take out roughly 7%. If you're on $150,000, it's more. If you've got rental income, it's off the total amount that you get in your account. It's wild. So keep this in mind. Even with car loans, personal loans, like Nathan said, it can strip hundreds of thousands of dollars from your borrowing capacity, and you might only owe 2,000 or 3,000 on that. So it could make sense to clear it to help maximize that capacity.
So as we have seen with Jonathan's story, even if you've been previously pre-approved, your numbers will most likely have changed. especially if you're thinking of going to auction. Think twice, work with a great mortgage broker to make sure that you're not going to get in a position where you put down your 10% deposit, you win, happy days, the champagne corks opened, popped, and you find you can't get your finances through. Keeping in mind the other things about reducing HEX debts, closing credit cards, and also looking at different lenders to maximize your capacity. Here at Hunter Galloway, we get mortgages approved, so hit us up at huntergalloway.com.au or call us on 1300 088 065, and we'll see you next time.